Welcome back, everyone. So I just did a quick search that said, should I pay extra into my mortgage each month? What if I told you that there is misinformation out there about the best way to pay your mortgage down faster? And the only people that benefits are the lending institutions, the ones that are putting out this information. What if I told you there's a better way to do it where you can retain ownership, use, and control of your money and give you the power to pay your mortgage off much, much faster, but giving you liquidity, use, and control of your money throughout the process, just in case if anything goes wrong, anything goes sideways, your health deteriorates, your financial deteriorates, your work deteriorates, you still got a bucket of money and the lenders aren't holding all of it for you. Well, in this video, that's what I'm going to show you. So make sure you like, comment, share, subscribe, and let's really dig into this. And let's look at this right here. Can paying extra towards my mortgage each month accelerate my debt repayment? And yeah, I mean, it can. So look, we're going to go through this and I'm going to show you a diagram, but the benefits of paying extra into your mortgage can be reduced interest payments, shorter term loan, increased equity, because not just because the appreciation of the house value, but because you're paying down the debt, which increases the equity. And then when to consider it, whether you have high interest debt, low interest mortgage, other financial goals, how do you do it? Bi-weekly payments, lump sums, make the adjustments, make additional payments monthly. And then I went through and I'm like, well, what other articles are out there? And then Rocket Mortgage has one. Should I pay my mortgage off earlier? The Ascent on Motley Fool has one out there. Forbes has one out there. And all of them, by and large, are basically saying, if you can, do it. But they're not telling you all of the story. They're not giving you, as Paul Harvey would say, the rest of the story. I just dated myself for those of you that know who Paul Harvey is. Anyways, I digress. So let's just assume right here that you have a $500,000 house that you put $100,000 down payment into, and I'll have another video on where that down payment should come from, but you financed $400,000. And I'm just gonna say we're back in the 4% cost of borrowing phase, because the reality is where people are borrowing money now, 6 and 7%, this makes even more sense. But let's just go back and say you have an existing loan at 4%. We're gonna say our safe money can earn 5% and our risky investments can earn 8%. So should you pay extra into your mortgage each month? And let's look at this right here. So if I go and I say, we're going to make an extra $1,000 per month mortgage payment into our house, and we have a 360 month term or a 30-year loan, and we're making $1,000 per month extra mortgage payment, in the 185th month, it will have paid down the debt. So look at it right here, 400,000 extra $1,000 mortgage payment. It will take 185 months to pay down all of that debt. Okay. And then after the 185th month, then the rest of that cash flow goes to lifestyle, right? It's all going to lifestyle, right? There's no savings. So your freedom point, which is when you paid the debt off, is 185 months, but you have 0 months of control of the extra payment that you're making. The lender has control of that money. You have 0 control of that extra payment. And that extra payment did not increase the value of the house. It increased the equity because you paid the debt down, but it has no bearing on the value of the house itself. The value of the house is due to market and appreciation. And we just assumed a 0% appreciation on the house. And the reality is it may go up a little bit more. I just did a video not too long ago that showed the average house appreciation is about 1.2% when you factor all the different things in. But then the potential assets valuing from the extra payments is 0. You have nothing extra to show for that extra $1,000. Now, the lender got use of your money for those 185 months, but you had 0 use of your money in those 185 months. 185 months is a little over 15 years, more than that, right? What's 185 divided by 12? Let me pull this up real quick. So I should know this, 185 divided by 12. Yeah, 15.4 years, okay? Not a whole lot of extra value there. But what if instead of making the extra $1,000 payment per month to the lender, what if you push that into our savings account right here, or the savings account that you should be in, the safe tank? And so an extra $1,000 being diverted into the savings account is equivalently the same feature that you were paying the lender off, except you're paying yourself off. And by doing that at 5%, your freedom point means having exactly the same amount of money saved up to eliminate the debt in one lump sum right there is 177 months, or 8 months sooner than giving the money to the lender. But what else did you get during that period of time? You got liquidity, use, and control. And after the debt is paid off, you have compounding interest that kicks in for the remainder of the 30-year term, which grows the asset to $575,000. Right? So now you only have, in the previous example where you just paid the lender, you just had the house to show for it by paying it off early. Now by paying it off early, you have the house plus the accumulated savings and the compounding interest, which is a value of $1,075,000, which is the difference is an additional $575,000 in your safe tank compared to the alternative that we went through. Think about that. That's important to consider when we go through this process. And then what if we take it one step further? One step further says, what if we put that extra $1,000 into an investment, a risky investment that could make money, could lose money, but on the average earns 8%? How long would that take us to pay the house off or have a freedom point? Well, freedom point now happens in the month of 158. Which is 27 months sooner than if you paid the lender, more than 2 years earlier than if you paid that extra payment to the lender. And then you have the rest of the term for that money to continue to grow because of that compounding interest. And now that earns or grows to $1.1 million greater than what you would have had if you just paid the lender an extra payment per month. So the point of this is, in the savings and in the investment bucket, you have liquidity, use, and control of those dollars while you're building up to your freedom point, which is enough money to pay the debt off. But if anything goes wrong in your life, if any disability, if any catastrophe, if you lose your job, if anything happens, you have a pool of money to pull from to take care and handle your business. If you're making the payment directly to the lender and a catastrophe happens, a devastating event happens, you lose your job, something happens in your family, they're not going to loan you the money, because banks only loan you money when you can prove to them you don't need to borrow the money. If you're out of a job and broke, they're not going to loan you money. So you're giving them money that you can never really get access to unless you can prove to them you don't need it. So this is something to think about. Yes, I love the idea of making an extra mortgage payment, just not to the lender. Let's pay yourself that. Let's find the proper vehicle where you can put all of your dollars in there. And we've been through this before, and I'll show it to you one more time. That place where you need to be saving your dollars needs to have all of these characteristics: tax-deferred growth, tax-free distributions, competitive rates of return, high contribution limits to be able to receive that extra mortgage payment on a monthly basis, or that extra payment from your mortgage on a monthly basis. Benefits, long-term care, living benefits, ability to take a loan from yourself or withdrawal for yourself in the event of a catastrophe, and the ability to pay yourself back at your terms, on your rates, on your time. Liquidity, use, control. Remember, if you're not having this discussion with your financial advisor, if they're not giving you this opportunity to learn this way, reach out to me. Like, comment, share, subscribe. Let's keep the conversation going. I hope you found this helpful, because this is the stuff they're not teaching you in school. Peace.